Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of these massive financial documents and sometimes find out if a company is cooking the books like a Michelin star chef. Today we're diving into Comtech Telecommunications Corp. Get ready because this filing is all about a major credit agreement shakeup and it hints at some interesting strategies ahead. Before we dive in, if you appreciate getting straight insights from these dry documents, make sure you subscribed and hit that notification bell. We also have a Discord community where we break down more of these filings, so check the link in the description below. Alright, so what's the big news from Comtech? Well, it looks like on July 21st of 2025, they inked some pretty significant amendments to their credit agreements. And these aren't just minor tweaks, they're changes that signal a shift in how the company is managing its debt and its operations. Think of it like a company saying, hey, we need a bit more wiggle room to get things done. The main event here is an amendment to their existing credit agreement, basically a big contract about borrowing money. What did they change? Well, a lot of the usual financial checks and balances got put on pause. Specifically, they've suspended the testing of things like the fixed charge coverage ratio and the net leverage ratio. This suspension lasts all the way until the four-quarter period ending January 2027. What does that really mean in simple terms? It means Comtech doesn't have to prove they're meeting certain performance benchmarks related to covering their debt payments and overall debt levels for quite a while. This is a big deal because it gives them breathing room if their financials are a bit shaky during this period. It's like saying, okay, boss, I'll get this project done, but don't ask me for weekly progress reports right now. Another key change is a reduction in their liquidity requirement. They used to need to have at least $17.5 million in readily available cash, but now that minimum has been lowered to $15 million. This might suggest they are planning to use more of their cash for other purposes, either investments or to cover immediate operational needs. They've also opened the door a bit wider for selling off assets. They can now sell certain properties and assets as long as the main lender approves. When they do sell these assets, a large chunk of the money, 65% of the net proceeds, has to go towards paying down their loans. The remaining 35% will go to paying down other subordinated loans. This is a way to manage debt while also potentially divesting non-core assets. And speaking of paying down loans, they're delaying some of the principal payments on their term loans. This is a direct way to reduce the immediate cash outflow pressure. They're also pushing back the payment of certain fees that were related to a previous amendment. Again, more cash kept in the company for now. Now about the interest rates. For a period until early 2027, the interest rates on their term loans are going up. For what they call base rate loans, it's 950%. And for SOFR loans, it's 1050%. That's a pretty significant rate. However, once they can prove they are meeting their financial covenants again after January 2027, these rates could actually come down. The new rates will vary between 750%. That's a pretty significant rate. However, once they can prove they are meeting their financial covenants again after January 2027, 50% to 9.00. We're gonna be on their net leverage ratio. So if they can get their house in order, the cost of borrowing could decrease. Here's a really specific detail about deferred payments. A payment of over $3 million that was originally due in July 2025 has been pushed back. It will either be paid at the end of the loan agreement or by January 2026 if certain reporting deadlines relate to their financial stability. If they can't get clean audits and demonstrate they can continue operating indefinitely, this deferred payment becomes due sooner. But wait, there's more. Comtech also amended their subordinated credit agreement. This is like a secondary loan agreement that usually comes with higher interest rates or different terms. This amendment introduces a new $35 million credit facility. Similar to the main credit agreement, they've also suspended the testing of financial covenants for this subordinated loan until January 2027, and they've adjusted the minimum EBITDA requirements. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a measure of a company's profitability. By lowering these required EBITDA levels, they're making it easier to meet these covenants. For example, the minimum EBITDA required for the four-quarter period ending January 2027 is now $26 million down from what it was before. This is a direct consequence of the overall financial pressures they might be facing. This new $35 million facility is called the Incremental Priority Subordinated Credit Facility. The money from this facility will be used to pay for the cost of these amendments, and then used to pay down some of the company's existing loans. Specifically, about $28.5 million will go to the main term loans, and about $5.8 million will go to the revolving loans. They are also reducing their revolving credit commitment by about $2.1 million will go to the revolving loans. They are also reducing their revolving credit commitment by about $2.1 million will go to the revolving loans. They are also reducing their revolving credit commitment by about $2.8 million will go to the revolving loans. They are also reducing their revolving credit commitment by about $2.1 million will go to the revolving loans. They are also reducing their revolving credit commitment by about $2.1 million will go to the revolving loans. And here's a unique part of how they'll pay interest on this new facility. The interest will be paid in kind monthly. That means instead of paying cash, the interest is added to the total debt balance. So the debt grows over time with unpaid interest being capitalized. This is a common strategy when cash is tight, but it also means the debt itself increases if they can't manage to pay the interest in cash. The interest rate for new facility is also quite high. It's the greater of the highest interest rate on their other loans, or term SAFR plus 10.5%. This is a substantial interest rate reflecting the higher risk associated with this subordinated debt. The company has to provide a certificate quarterly from its CFO or treasurer detailing these interest rates. Looking at the minimum EBITDA requirements again for the subordinated debt, they've also lowered them. For the 4-quarter period ending January 2027, the minimum EBITDA is $26 million. For the period ending April 2027, it's $28 million, and so on up to $32 million by October 2027. These are lower than what they might have originally agreed to, indicating a need for flexibility in meeting their financial obligations. To really understand what's driving these changes, we might look at an accompanying press release. While we don't have the full details of that specific press release here, the fact that they're announcing this facility and these amendments strongly suggests they are trying to stabilize their financial position and possibly fund future growth or necessary restructuring. Now let's put this all together. Comtech Telecommunications Corp is clearly navigating some choppy financial waters. By suspending key financial covenants and deferring loan payments, they are buying themselves time and flexibility. This isn't necessarily a sign of imminent collapse, but it does indicate that their current financial performance has necessitated these significant adjustments to their debt agreements. The increased interest rates on some of their loans and the use of paid-in-kind interest on the new subordinated facility suggest that accessing capital is becoming more expensive and perhaps more difficult. The strategy here seems to be to manage immediate liquidity pressures and to have room to operate, perhaps while they execute a strategic plan or deal with market challenges. The suspension of covenants until early 2027 is a substantial period which gives them a long runway to improve their financial standing. However, the deferred payments coupled with the potential need for auditor sign-offs without going concern warnings are a flag. It means if their business doesn't rapidly improve, there could be a crunch point. The company's direction seems to be focused on survival and restabilization. They are employing financial engineering to manage their debt burden and create operational freedom. Key risks include their ability to meet the revised EBITDA targets and to eventually come off these covenant holidays without triggering defaults. An opportunity could be if these amendments allow them to successfully execute a turnaround or capitalize on market opportunities that were previously out of reach. Due to financial constraints, in my opinion, Comtech is in a defensive posture. They're proactively reworking their debt to avoid distress. The success of these moves hinges on their ability to generate sufficient cash flow and improve profitability over the next couple of years. They're essentially hoping to outrun their current financial challenges. Alright, that's our breakdown of Comtech's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think these changes are smart, or are they just kicking the can down the road? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.